Hi everyone, welcome back to our channel. Today we're looking at the basics of capital gains and losses and what that means for tax. Let's get started. When there's a difference in the value of an asset when it leaves you compared to when you got it, there is a capital change. Capital change doesn't apply to all assets, but we'll look at that next. The starting value could be a purchase price or an assessed value for the date when the asset was given to you. This is the value at the date of acquisition. The second value is often a sale price. For estates, a capital asset is considered sold or transferred at the time a person passes away, so the transaction could be the owner passing away and the property falling into their estate. As we mentioned, capital change doesn't apply to all assets. For example, it doesn't apply to daily checking accounts or personal items. Capital property is property that can depreciate over time. For most people, capital assets are real property, such as cabins and shares of privately owned corporations. For real property, it's important to remember that capital change does not apply to a principal residence. Each tax year, everyone can claim one principal residence that, if sold, would not incur capital gains tax. This is a property that is not used for recreational purposes. For example, the home you live in is your principal residence, whereas the cabin you go to for the summer is a recreational property. A capital gain happens when there is an increase in the value of an asset, and a capital loss is when there is a decrease in the value of the asset. In this example, Sam has a capital gain because the property sold for more than it was acquired for. Joe has a capital loss because the sale value is lower than the value on the date of acquisition. Let's look at gains and losses more closely. The idea of gains and losses is pretty straightforward, but where do these numbers come from? A vendor can't randomly assign a value to an asset. The sale price is based on the fair market value. This is how much the asset would sell for on the open market. For property, this value is often determined by a real estate agent. The number is impacted by the location, what other properties in the area have sold for, and whether or not people are looking to buy. The second factor to consider is what we call an adjusted cost base. This is calculated by adding the value of any improvements to the asset to the value on the date of acquisition to determine the true value of the asset. Let's look at an example. Let's say that in 2010, Jack and Jill purchased a house for $50,000. Over a couple years, they added an extra room, which cost $2,000. They also upgraded the HVAC system, which cost $5,000. In 2020, they sold the property for $100,000. First, we know that Jack and Jill need to consider a capital change because this property is not their principal residence. Next, we need to calculate the capital change to know how much Jack and Jill can expect in terms of tax. The fair market value is simple. The property sold for $100,000, so that is the fair market value. The adjusted cost base is a little bit more complicated. We know Jack and Jill bought the property for $50,000, so that is the value on the date of acquisition. Since then, they made two notable improvements, one that cost $2,000 and one that cost $5,000, so we add these numbers to the $50,000 starting value. The difference between the fair market value, or selling price, and the adjusted cost base is $43,000. Since this is a positive number, we know that Jack and Jill have a capital gain. Only a portion of the capital change is subject to tax. A capital change of $43,000 does not mean that Jack and Jill get $43,000 added to their tax. 50% of the capital change is taxable and is recorded as income for the year the transaction took place. In a case where the person passed away, the value would be included on the Terminal T1 tax return. For Jack and Jill, this means that $21,500 gets added as income, which is then taxed. Often people ask if selling the asset to their child will prevent capital gains tax. The answer is no. The tax is created by the transaction itself, so it doesn't matter who the recipient of the asset is. When tax is incurred, it's payable by the person whom the asset is leaving. In the event that the person is deceased, the tax is payable by the person's estate. When there is a capital loss, a negative value for capital change, the same rule about 50% of the change being taxable applies. For a capital loss, 50% of the capital loss is applied to the income tax return, which can help offset the amount of tax owing for that year. Let's look at Joe from earlier. He had a capital loss of $25,000. Half of this value is $12,500, so Joe can include $12,500 on his taxes as a loss to be used towards balancing out his income tax return for the year. Where to find us? Visit our website, butlerwillsandestates.com, check out our blog, estatelawcanada.blogspot.ca, or contact us directly at chelsea@butlerwillsandestates.com. If you liked that video, make sure to click the like button, and if you want to help us keep making videos about a variety of estate law topics, make sure to click the subscribe button. Thanks for watching, and we'll see you at our next video.